I'm just going to invite Michael Pope up onto the stage. Michael heads up our personal accounting area of our business. Now, we're not tax advisors, so we talk about it being personal accounting because it's really about budget planning, cash flow modelling, and he complements all the work we do in terms of the other areas of our business. So everyone's got their brochure in front of you. I want you to sort of just follow this with me in terms of this live demonstration. Anything that's live is always a bit of fun. So Michael, if you just want to check that you're good to go. Okay, great. So this section is really important, but I'm going to hopefully make it as simple as possible. But the fundamentals aren't simple, okay? There are a lot of variables moving through cash flows and moving through households and a lot of things that influence and test money, okay? And this caption that I've got up here is a pertinent one. BHP released their results yesterday, and they also announced that they're ceasing the Olympic Dams expansion, which was about a $30 billion expansion. Now, that's a big decision, and that's a hell of a lot of money. Now, do you think that they would make that decision on a gut feel? Do you think that they would make those types of decisions without detailed analysis? They've probably paid millions of dollars to consultants to tell them whether this is a good investment or a bad investment. Now, the message I want you to take away from this, and the thing I want you to put on your head right now is just a thinking cap to say, when you're looking at your own household, think of it as a business, okay? Because there will be millions of dollars flowing through your household. It's a fact. The longer that you work, you'll be scared to know exactly how many millions actually flow through your household. A lot of them obviously are used up in survival, in living, in discretionary spending. So it's a really important thing. I just want you to put your thinking caps on. Now, there's sort of two parts to what I'm about to talk about. I'm going to try and set the foundations right. So I need to give you some teachings around some of the basics because I'm going to go into a spreadsheet that could potentially just overwhelm you. Okay, so it's really important that I try and get the fundamentals right so we can go through that. So let's start. So obviously this is the steps that we take when we're basically working with a customer from step one through to the final implementation and then the ongoing management. It's really important to understand that. So this is the area that I'm focusing on tonight in this presentation and in terms of how we go about that process. So the first thing we're looking at is what opportunities live there and in terms of clarity. So in clarity, we're talking about let's collect some information and let's understand what that money needs to do for you. All right, again, it's all well and good if you're a power, egotistical, hungry person and it's all about your ego, how much money you have. But the majority of the people that we deal with, it's not about that. It's about having enough to do the things that's important to them. And that's the sort of stuff. So I want a bit of interaction in terms of I'm not going to let you get away with not asking me any questions or giving me any feedback. So to do that, we usually use a fact find. No different than any other business they normally send out. Give us a little bit of information about yourself and we can then basically look at and evaluate that information. So a bit of diagnosis. So in terms of that information, we're just going to jump into the fact find. Okay, so inside this fact find, we're going to ask you some simple information. So I'm going to quickly run through this. We're going to ask for your personal information. We're then going to also look at your income, and income's critical, okay? It's obviously an important part of what we're doing. So in this particular case, I want a little of audience interaction because we're going to look at expenditure and we're going to look at bills, fixed payments, those types of things. So for this particular couple, we've just got $65,000 and $45,000. Is that reflective of households? Okay, some are going to be obviously a lot more, some are going to be a little bit lower, but is that sort of the middle of the run? We're happy to sort of work with that number. When we did the ABS data about 3 years ago when we first designed this tool, it was around 100,000. So we've moved it up to that 110,000. So let's just use that as our starting point. Now, if you're a single in a certain household, if we have enough time, we might do a quick model for an individual person. But right now, we're just going to focus on doing a couple. So we've got that income. We go to the next page. We've currently got a home worth $480,000, so a little bit below the median house price, which is hovering around that $520,000, $540,000 range, depending on which data pack you use. We've got some contents inside the home. We've got $15,000 either in our offset or in available to redraw. We've got around $96,000 and $79,000 in super, so a little bit accelerated super there. We've got a couple of cars, which don't make us any money, so we never include them as assets in terms of wealth modelling. We've got no investment properties. We've got borrowings. Currently, we've got a $271,000 mortgage at 7.25. So we've actually, the market rates for mortgages is just under 6% at the moment. So we've just accelerated that up a bit so you can actually see if interest rates were higher, and we can obviously model that through our tool as well. So currently, we're paying $2,142 per month on our mortgage. In terms of our credit card, we've got no credit card debt. So we're doing something right here. We're actually not letting credit card debt or personal get on top of us. So the next thing we're looking at is our bill payment. So we've got our rates. Does everyone think $750 for rates is a little cheap, maybe? Okay, throw it at me. How much? $1,100? $1,500. Let's put $1,500 in there, Mr. Pope, if we can. Beautiful. Okay, water and sewerage, house and contents insurance. Anyone want to question this? Bit higher? Higher for the contents insurance. $800. $1,500 for house and contents insurance. Shop around, Nick. Seriously, shop around. Let's put that at, say, let's call it $1,000 then. Electricity every 3 months. Gas every 2 months. Phone bill monthly $90. Health insurance. Life insurance. So it's good to see they've got all the defensive structures around them. I mean, you are the most valuable asset, not your car. Insure yourself before your car. Get your third party, but you're more important. You're going to make a lot more money than what your car's going to be worth, I can tell you that much. Car insurances, registrations, motor organisation, bank fees per month, so you've got a professional package mortgage. Subscriptions around $120 yearly. The income tax protections in there at $2,000 a year. And you're paying your accountant around $30 a month, but it's maybe a one-off fee that you pay. So there are our bills. Now our spending. So mixture of obviously essential and discretionary in here. So it's really up to your household. And again, we're not about sharpening your budget today so you can enjoy the spoils tomorrow. There should be a way in which we can manifest an outcome that allows you to have a reasonable living today with a bit better future tomorrow. So we're looking at this. Groceries, everyone agree around $680 for husband and wife, no kids at this point. Bit low, bit high. Not too much debate there, so we'll keep that normal. Footwear, clothing, $170 a month. Yep, I think that's pretty reasonable. Medical and health care insurances. Yep. Anyone's got any objections on anything on that page? Fuel, $380 a month. Car maintenance, $850 every 6 months. Holidays, $6,000. So they're not really skimping. They're still enjoying themselves. They're still living for today as well as hopefully focusing a bit on tomorrow. Sport, recreation and hobby, $125 a month. Entertainment, the odd concert or two. Alcohol and tobacco, $220 a month. They're certainly not missing out. Okay, that's a couple of nice bottles of red. So we're starting to get, we're not doing any gambling or lotto because obviously we're here to make money instead of gamble for money. Okay, so we're not gambling anything. So that just gives us a sense of that spending. And again, all of that is personalised. Your own circumstances could be completely different. You could be the world's best saver. You could also be the world's best spender. And sometimes there needs to be an honest conversation had if you wanted to seek advice in that space. Moving along. So what we've now got is a summary of their personal circumstances. And we've got the income flowing in. If we move down, we can see we're paying, we've got our deductions, we've got our estimated tax. So we're paying household-wise about $18,000 in tax a year. And then we look at the old overall expenditure. If we isolate these 2 points here, $15,000 and $36,000, we've got around, that's obviously ramped up a little bit now. So what are we talking there? Around 53? 53,000, yep. And then we've got our loan repayments, which is taking a fairly large bite size out of our cash flows. So you'd think the moment we get rid of our loan, happy days, but we'll see what we can do whilst we still maintain our loan. So down the bottom here, we're actually at a point where we break it down. So we've got the monthly income, we've got our expenditure, and overall, we've got a surplus of around $13,000, $13,500 to round it off. Okay, so that is a good indicator as an advisor as to what I'm playing with here, okay, and in terms of what I'm looking for. And when we went back to step one, what's the goal setting that we were doing? So when I'm interacting and advising with clients, I want to basically know what it is we're trying to achieve. So the goal for this particular couple, when we go to the next page, we've got a lot of future activities in there that we're going to demonstrate to you later, is $80,000 household income in retirement. So the day that they retire, which is the age of 60, they want to basically be able to live on $80,000. So it's quite an aggressive target. Just to give you an example, the last data that I looked at was that 90% of people are currently retired on less than $43,000 a year. Okay, and everyone's super's had a big hit with the GFC. So there are a lot of people returning to work because they have to, because they haven't been able to generate a wealth base that can sustain them in their retirement. So that's important to note. So we've got a snapshot. So that's our fact find. So we're obviously, taking in all this information and starting to sort of understand it. And if we look back at our form here, we can see we're starting to evaluate. We're starting to assess and analyse that information, starting to build up a bit of knowledge in that space. So when we're doing that, we're looking things like surplus cash flow is the key. I mean, let's be honest, we can't create money out of nothing. If you don't have surplus cash flow, you're going to have no hope of getting anywhere in terms of creating wealth. Your money is fully allocated. Okay, so something needs to give. You need to cut down on your expenditure, or we need to get a greater income coming through. Okay, because we're still going to have to go to the bank potentially to borrow. We're going to look at the current projections. So maybe this might be a little sneak peek, Michael, in terms of that. Now, whilst Michael's doing that, something I prepared a little bit earlier, which is actually with the assistance of Bryce. This is basically what we're looking at here, and I'm just going to make a record of these so we can keep referring back to them. Are we a little bit overdone? Bring it forward. Can everyone see? We all good? Okay, terrific. So Michael's now going to take us into our wealth simulator tool. Now this is a very powerful financial modelling projection tool. Okay, it's been developed over the course of the last 3 years inside our business, and it's purpose-built to build property investment portfolios. It obviously does incorporate other investments and does incorporate taxation and superannuation and transition to retirement and everything to do with our models. Am I interrupt? Are you guys, you're okay? Fantastic. Okay, so if we just have a quick snapshot at the interest savings. Now, the point I want to make here is this. We saw around $13,800 there, and I called it 13.5 earlier, in terms of surplus cash. If this couple, if John and Amanda trapped that surplus every month or every year, that 13.5, they would be able to write off $152,000 in interest. And they would be able to save 11 years on their mortgage. And that's pretty good going. Okay, but we haven't factored in any kids, we haven't factored in any variables yet, but that's just what they can do through better money management or having a budget set by the information that they've given us. But is that the best use of their money? And that's obviously what we're here to put out there in terms of the lessons we want to teach tonight. Is that the best use of our money? Well, let's go back into the slide pack and we'll take a look in terms of how that plays out. So we're looking at current projections, and we'll put some of these more numbers up in a moment. We want to look at investment options, and we're not saying that property is the only investment that you do, but we are definitely declaring that we do like property as an investment. It's our specialty. It's where the majority of the skill in our company lies, because the majority of us have been doing it for many, many years. And we think we can do a very good job in that space. And that's why we're confident of the returns we'll be able to get for our clients. Future plans, okay, things like new cars, one-off holidays, renovations, starting a family. They're all the sort of things that are going to have to be factored into those cash flows. And every dollar that's factored elsewhere is obviously going to have an impact on that number there. Understanding those opportunities. So again, through interaction of having that conversation with our clients, we're starting to understand goals, aspiration, dreams, what it is that money's going to do for them. So I mentioned before we have a bias towards property. Why do I have that bias? Now I could talk about this for hours, but that's not what this presentation's about. So I'm going to summarise it in hopefully 2 slides. The first one here is, I said we had $13,000. If you had to change the numbers, I was working on only having $8,000 in surplus, but we had 13. Now $8,000 in surplus cash, through some other presentations that some of you have seen, I've clearly demonstrated that you can actually buy an investment property if you've got the income and the equity supporting that can control an asset worth $300,000. Now, are you owning that asset? Well, technically it's in your name. The bank's owning it because we're borrowing money. And what's the science behind borrowing money? Because that is the biggest fear of anyone who's getting into property investing. So I'm trying to alleviate that fear through people understanding how to manage money better. So to do that, let's just have a look at some of these. Term deposits, well, they're offering around 5% now. Managed funds, well, that's been the long-term performance of most managed funds. If we take a generalised view, I hate generalising, but if we take a generalised view. If we do shares, well, they've had a pretty good time of it. I mean, over the longer term, around 10% growth, 5% yield. So if we had to put our $8,000, we're going to make around $1,200 in return. That's a 15% gain on our money. If we have direct shares and we leverage those direct shares, in other words, we borrow, margin lending, grab some of that money, and we got a 15% growth and 5% yield, then we'd get a 23% return on our money. Sure, we've got to cover off on the interest, but that's basically what we're getting. Now, this was my point before, and it's just to simply illustrate this, because I'm not going on the why the benefits of property are better. That's for another conversation. But $300,000, if we got 7% growth and 5.5% yield, then technically it's still a paper gain, because it's $21,000 if you just times the growth by the value, less the $8,000 that we're putting into the conversation to control that property. So we're putting money in, the renters are putting money in, we might be getting some tax rebates and concessions coming through. So cash on cash return is 160%. So if we move to the next slide, that's a compelling argument. I mean, all we're trying to say is if you can control that asset over the longer term and it performs on the linear curve that we think it will perform over the longer term, it's an investment grade asset. We don't select a lemon. It's game over. Now, one could potentially argue that shares could do the same thing, but the volatility is great. Bryce mentioned earlier that there's, the market's corrected itself, and this is the general Melbourne market by 8.3%. But we've failed to demonstrate over the 2 years before that the market's grown around 35%. So we're taking a breath. And this is actually one of 2 rare occasions where we've actually gone greater than 5% correction. Now, has every property done that? No. Bryce also demonstrated the properties in, houses in Carlton have gone up 13%. So to generalise about the market is not the conversation you need to have, because you're not buying the index. You're not buying the property index, you're buying one property at a time. But that's the compelling reason why you would, because what is it doing? It's accelerating your outcome. But you've got to make sure that you select right, and you've got to make sure you can afford it over the longer term. So if something comes into your life and you can't afford it and you have to sell it, it's been a dud, because it starts doing its heavy lifting at the end, not at the start. So we've basically summarised it, we've diagnosed it, and we've got a bit of an understanding of what it does. Okay? So let's go back now. I'm pretty sure I'm going back into, into the slide pack and have a look at some things like cash flow management strategy. So we're sort of seeing things to identify where cash comes out. Sorry, Michael, I will finish this piece. And this is saying a couple of things. So let's say in your household you do your budget and you have a mortgage and you don't think there is enough left over. Well, you may not be actually right. And this is what this particular graph shows. So we've got a loan balance, $80,000. We've got 8 years remaining on our loan term. We've got principal and interest repayments if we choose to pay down debt to make this amount of money. So we've got $1,071. If we pay interest only, it's only $433. So if we do a variance over a 12-month period and just paid interest only on that loan so we could grab another asset that's appreciating in value, we could actually find in our household budget $7,600. Almost that $8,000, yeah? What if we had a loan of $175,000 and we had 12 years to go? We could find $9,000 in our budget. What if we had a $300,000 loan? We could find $11,000 that's paying off that principal. Okay, so it is basically paying off debt. We're actually saying don't pay it off yet because we're in the accumulation phase of where we want to go. Okay, so we're trying to bank up the amount of assets that we control and then we want to transition debt out, and we'll show that in the simulation shortly. Then we've got the $400,000. Okay, so again, 20 years to go. If we set that to interest only, we've got $9,700. So potentially, it's not out of thin air, it's your money. You're just being more sophisticated with your money. You're just making sure that you're controlling it better with a bigger goal in mind, a bigger dream in mind. That's the real important thing. So we're now going to get into the technical assessment of property. So when we're doing a strategy, we've got the broader strategy, the plan, and then we've got the tactical component about what we're doing it. And when you're looking at the tactical component, this is where I step in. As a qualified property investment advisor, we use, or there are available to us, in our view, in our investment committee, around 12 different strategies, and they're not mutually exclusive, and they probably don't make sense to you. So I'm just going to mention a couple of them, but this is in-house talk. These are the strategies we can use to help you get there. The proven performer, that's your blue chip location, okay? That's our most predictable selection. That investment grade asset has proven to perform, it's got resale history, and we don't think there's any reason why that asset won't continue to perform over the long term. The rare earth, there's a combination of a fully utilised area that's going to be regenerated, so that earth is becoming rare. And Bryce is true, it's not about land size, it's about land location. So that rarer the earth, then we're also very interested in understanding that in terms of our strategies. The wave rider is an example of an area that's just nestled right next to an area that's gone very well, that's probably had that demographic shift. And by having that demographic shift, it's only logical that the surrounding areas are going to get some drag up. Okay? The piggybacker, a favourite of mine, that's when we buy an old existing, maybe tired-looking apartment right next to a group of really fancy, great apartments, and we just get that piggyback. We just jump on their back, they reset the benchmark, and over the next 20 years, we're going to get, exponential growth or outperform result because we're carried on the back of the new benchmark pricing in that area because they got fancy European appliances. We can always renovate those properties as well. So that just gives you some examples of some of the strategies that we're obviously looking at as an investment committee to try and find that right fit. Now, do we do it for everyone? No, we don't. We're looking at the cash flow requirements of each client and we're tailoring the strategy accordingly from the feedback we're getting from the client. But there's things we need to consider here. The risk versus the reward. Okay? Some of these strategies are highly risky. The land optimizer, he's trying to slice and dice some land with the one up above. You've also got the rare diamond. They're trying to renovate and flip potentially. Some of these are a higher risk and a higher reward. So you've got to understand those things. You've got to understand your reward for effort. So if you're going to put your time in, when someone comes in and says, I've got this great idea, I'm going to do this development, and I'll say, so what hourly rate are you giving yourself as project manager? I'm getting someone else to do that. Trust me, if it's your money and it's your project, you're going to have to spend a hell of a lot of time on it. So if you're not at least charging your time out at $100 an hour, does it still stack up? Because it's a second job. So if it's going to be a second job, you should be rewarded for that, and it should be factored into your feasibility study. Dreams versus reality. Oh yeah, I want a helicopter and a Ferrari. And what sort of income have we got? What sort of surplus cash? Oh, we've got about $5,000 a year. Well, the reality is we're not going to be able to achieve that unless we've got maybe 30 or 40 years to work with you. Okay, so we've got to have a bit of a reality check sometimes. The fear, the procrastinator, the 9 out of 10, or the 7 out of 10 who just buy one, versus the greedy ones. Oh, this is easy, this game. I'm over here and, I bought in 2007 and the market went whooshka, and this is an easy game, so I'm just going to keep buying. I mean, game over. I'm set. Doesn't work like that. The market doesn't keep running like it does indefinitely. So you've got to be fearful. So there is opportunities, as Kate was saying in her, comment from Warren Buffett. Be greedy when others are fearful, i.e. great time to buy when you've got less competition, but be fearful when others are greedy, when the market's starting to peak and there's runoff. So that's obviously part of what we try and avoid when we're advising our clients. Theory versus experience. There is no substitute from pounding the pavement. There is no substitute from getting out there and doing 10,000 auctions. There is no substitute for that. That is experience. You can read as many books as you want to read, as many magazines as you want to read, but when you collectively have the knowledge and experience, that's priceless if you learn from those things. And we've all made mistakes as investors. I sold a property I should never have sold. I won't talk about it. Still hard up on it. Timing versus time available. Timing, yes, there are opportunities in certain markets. Timing the market can actually do well for you. Time available. How much time do you have to allocate to this? Because if you want to go off and do it yourself, we encourage that, but be mindful, it's not going to be easy. Might sound simple, but it's not going to be easy. So, be realistic about the time you have available for this. And for some people, they don't have the time. So, as Bryce said, they just outsource it. Desire versus ability. This is the mirror test. I use this quite a lot with my clients, and I say, you have the desire to be here, to have this type of income, to have this type of lifestyle. I'm asking you, do you have the ability to make it happen? Because I'm looking at your numbers, and I've seen that you've already generated a couple of $1 million in income over the last 15 years, and I'm seeing a net worth of around $400,000. So something's got to give. So if you're prepared to learn, like you guys have come here tonight to do, then that's great. But have an honest conversation with yourself. And if you don't have the ability, it doesn't mean you don't have to do it. There are people out there who can help you. Technical property investment selection. Now I'm going to quickly get through this point because we're getting close to jumping into the simulator. It's very clear. The better the asset selection, the better the overall result. So if a market performs well and you get these types of numbers, they're game changers. So that's the business we're in. We're in the business of adding value. If we don't add value, we wouldn't have 1,300 clients. That's what we do. So this is the simulator tool, and before I get into it, I'll just explain this little graph here so we know when we're talking about a few things. So yes, that's the value in future value terms. This yellow line here is the debt line. The blue represents our owner-occupied home. The red represents investment properties, and the white bars represents superannuation and or savings. Okay, so that's just something to take us through to the next bit. So let's get going, Michael. This is the fun bit. How's everyone feeling? And how am I going for time? Beautiful. Okay. So we're going to go now into the wealth projection. And this is John and Amy up the top here. So we're seeing here, I just need to take you through a little bit more teachings in terms of what we've got here. Net wealth, that is in future value terms. So that's obviously the house growing in value over the next 40 years, and that's superannuation because we trapped all of that cash and we paid down our loan so quickly and we saved those 11 years and the $152,000, The next assumption that's made in that model is that 75% of that 25,000 that we were supporting our mortgage with is now actually being injected into super. So the nest egg, which is the most important for any of us because we really shouldn't have to sell our house to fund our retirement. So the nest egg is basically all the investments that we have. And in this case, it's purely just super and savings because we haven't invested yet. So we're seeing that in future value terms at 2041 with an indexation of 3% for inflation. You're seeing that basically as 3.6 million, which in present value terms is $1.5 million. Now, if you're getting a 4% return in terms of dividends, then you're going to basically have around $61,000. So if they manage their money well, now we haven't had kids yet, we haven't had a few things, so they've got to debate these things, and we're going to show you in our live illustration exactly how that works. So that's where they live. So let's go this. Our net worth in present value terms is, we don't have the net worth in present value terms, but I've got nest egg. So we've got 1.5 million, and that's going to give us 61,000 in income in retirement. And obviously you can see it's reasonably confident in growing, but it's just coming off there depending on the performance. So I now want to go into the parameters worksheet. Now this is where we basically have all of our variables working in real terms and in live simulation. So you can see here we're currently aged 32 each. We're born in August of 1980. This is the current time. We've got our income coming through. We've got living expenditures all summarised here. There's our superannuation. There's our family home. There's the current money that we have in our offset or our redraw. We're scrolling down. There's our credit card with no debt. There's our current balance on our mortgage. There's the repayments that we're making. And there's not really much else other than our retirement timelines. But I just want to take you through some of the variables that are playing in real time when we do our calculations. And these are it. So at any point in time, we can influence any one of these variables. So similar to like a yield manager or someone who's sitting very high up in BHP, a financial controller, they will have these levers that they can adjust and report back to the board. Well, it's no different than the levers that we would have available to report back to you in terms of whether you can make more informed decisions about your money. So in this particular case, let's just quickly summarise them. We've got wages growing at 3% to keep up with inflation. We've got spending growing at 3%. We've got superannuation contributions at 9%, and then the taxable rates. We've got our savings, we've got our property. Every property acquisition that we make is costing us 5% for stamp duties. We've got asset growths. We've got asset growth yields on the investment properties. We've got rental growth at 7%. We've got occupancy at 90%, so we're not fully occupied. We've got management expenses at 7.7. We don't want to manage the properties. We're not experts at that. Give it to somebody else. Pay them a professional fee for doing that. Then we've got loan interest at 7.25. We've got maintenance costs growth running at 3%. Purchasing expenditure, selling expenses, etc., etc. So at some point in time, we can use that as our general models, or we can actually go and be specific by property or specific by investment. And that's what we do. We go away, crunch the numbers, and then come back and show you a strategy document that may be successful for you in being able to do that. So that's their current situation. Now, if we actually just have a look, Michael, in the... Let's go and have a look. So what we're going to do is we're going to actually see whether they can afford an investment property. Okay, can they pay for that first investment property? So the first one we're going to look at is investing in a property for $350,000. Thank you, Michael. And they've come and got a pre-approval. They've got their finance all sorted, and they're about to buy this $350,000 investment property. And we're going to buy it in November because we're not going to rush into it. We're going to take our time, but we're going to start looking, understand our market and basically have a look at how that changes our wealth projection. So Michael's just calculating. That takes that data and brings it across to our simulation tool. And inside this simulation tool, we're now starting to see. Now, with that, we've actually borrowed 105%. So borrowing 105% of that property worth 350,000, we've now got a debt of 367,500. Okay, and we're buying that in November of this year. So let's have a look at how that's impacted on our wealth projection. And there you can see our debt's obviously going to last longer, because we've got that one investment property, and you can see the red investment property coming in there. And let's see what it's done in terms of our numbers. So right now, we've opted not to pay down debt, because yes, we were able to do that by using that $13,000, and we've got $61,000 as a passive income out of that. We've now got our net worth at, that's in future value terms, so I'm just going to keep those blank for tonight. What I'm going to do now is look at the net worth in a nest egg in present value terms. It's 2.2 million. Okay, and what has it done? It's added an extra $29,000 in passive income each year, because we're not selling it. And you'll notice here that the wealth continues to grow. So if you actually were to maintain that asset and you kept putting the rents up and you paid the debt down, well, all that rental income's coming to you, and you're now in a situation where you'll actually each year starting to give yourself a pay rise with how well you increase the value of those rental properties. Can we just go into the graphs that you've drawn for us, Mike? Okay, so these graphs here are telling us some interesting analysis as well. So you can see there, this is how our wealth projection looked, and by just adding that one investment property, there's our wealth projection. What we're monitoring over here is cash flow, and our cash flow position is basically telling us that we're not getting into any red zones, so we haven't run out of cash flow. So we've still got a cash flow buffer, and so we passed that test there. And down here, the good news story here is we've got a deduction in our tax. Now, we're paying around $18,000 in tax for the household. Well, by holding that investment property, and the model that we've assumed just for the record at the moment is 7% capital growth, 4% yield. Okay, and we can start playing with those drivers in real time. So there's our first one. Let's go shopping again, and let's see if we can get our second investment property. Now, our second investment property, we're going to pay $400,000 for this investment property. And I'd like to buy it 12 months later. So the question is, can we do it? Do we have enough surplus cash flow to cover the shortfall each month? Because we've got a shortfall. We already borrowed all of that money to start with. So do we have enough surplus to make this successful for us? And you can see here that the graph's now changed itself, that we're now going into a negative territory. And just to show you the sophistication of the tool, if we actually go into scenario 3 and have a look at what those numbers look like, behind all of these graphs are some pretty serious numbers. And inside these numbers are factoring in all of those variables, pushing the treatment of cash the right way. And you can see here, there's our negative cash flow. So the moment we bought that second investment property, we started going negative. But because we had a little bit of a cash buffer there, remember we had around 15,000, it didn't actually take until 2017, 28, that we actually ran out of cash. Now, if we go down lower, just to illustrate that in month-by-month terms, you can start to see we're going negative and we're running out of our surplus. We're running out of our surplus. We're out of the game. We're illiquid. So can we afford that second investment property? Well, the question is not at 7% growth and 4% yield. But what if we played around with the yield figure, just for illustration purposes? There are markets where we may be able to get a higher yield. We may be able to get a 5.5% yield instead of a 4% yield. So on that second property, we're now going to demonstrate what a 5.5% gross yield would do to our cash flows. Our overall graph's looking great, but the bottom line is we ran out of cash. Okay, so let's go back in and have a look. Now, this is really interesting. by just changing those one variable, and for the record, there is no depreciation benefit in our calculations at this point. When we do, because each property is unique in its depreciation ability. So we've decided that depreciation is a cash flow benefit to us. So if it works without that depreciation cash flow benefit, it's going to work with it, and it's going to work even better. Okay, but we are building some newer versions of our spreadsheet to accommodate each individual property for depreciation. So you're now starting to see, here's the scenario. So we go back into the scenario 3 and have a look at those cash flows. Sorry, Michael, that's giving you the irrits, isn't it? All of that popping up at the bottom. So you can see there our accumulated surplus cash flows are still moving nicely. Scrolling down, we start going into negative, but because we've got that higher yield point, we actually don't break the bank. So if you then feel comfortable with that as a more aggressive strategy, because we would normally not be one of these people who says, let's buy one a year, unless our clients are telling us, yes, our risk profile says we are a little bit more aggressive. Yes, we do want to go a little bit quicker. And also bearing in mind some people here may be a little bit later in their lifespan than others. And sometimes, I'm not advocating going aggressive, but we would do a different type of strategy where there may be more focus on yield with obviously our attempts to get the best capital growth we can, but that cash flow is what you want to be living on. Okay, so you don't have the time that this couple does have to make that work for you. And then obviously if we then were to package this up and get more and more properties, the brief would be quite clear. So in terms of point 4, the implementation stage, you could potentially go out and implement that yourself because you know what you need to look for. You need to look for a property that's delivering 5.5% yield and the prospects of delivering 7% longer term growth. Okay, so that just gives you an idea of the strategy stuff that we're doing. Now, again, we've been kind on this couple, but they've come back to us 6 months from now, and they've actually said, you know what, we thought we weren't going to have a family, but we are. So we're going to start a family. So they've already bought their first investment property, but now we're looking to start a family. So what does that mean? Well, firstly, it means that we should have known that first, and hopefully we know that before we try and make the mistake of buying something different, because you're going to give up that opportunity of wealth creation. If you buy a property, rule of thumb says that property won't make any money for you, usually in the first 5 to 7 years. It only becomes a sweetheart deal when you hold it for as long as you possibly can. Sure, some properties are going to run, some markets are going to run, and obviously that's what we're trying to do. But that's the important part. So now we want to start a family. So we're going to have Amanda going on maternity leave for 12 months. So Michael's going back in, changing her circumstances. And we're taking her salary away for a 12-month period. Now, of course, we've got things like childcare, potentially. We've got primary school, we've got secondary school, we've got the big choice of private versus public education. There's all of these types of things, and we can model all of that. We can basically, you can tell us the figure, or we can tell you roughly what those fees are going to be in regards to that private schooling. You might go Catholic over full private, whatever it may be. We can put all of that information. You can have kitchen renovations, you can have carports, whatever it is that your circumstances are, you're starting to see the picture. So we've just changed her income to accommodate that and stopped her income for 12 months. Let's just quickly go back and have a look at what that impact's done. So you can see here, just by looking at the cash flow position, there's no hope of that happening. I mean, we were tight as it was, so it's pretty logical to say that second investment purchase isn't going to happen. But is it not going to happen indefinitely, or is it not going to happen now? Because the point is, one property is not going to create an income for life. A portfolio of properties is going to be your best chance, coupled with your super, that's going to be able to create that very healthy and wealthy income for life. So in this particular model, we're going to just push that purchase out. So yes, we're going to start a family, and again, we would do a lot more work in regards to how much childcare you're going to need, what sort of school fees, and we would model that whole scenario through for that client. And then you would start to see, okay, well, in that particular time frame, it's not going to happen. So we might push that purchase, Michael, let's push that purchase out to 2017. Now we push that purchase out to 2017. And let's see if that works. And the answer again is no. Because what's actually happening here, by Amanda going on maternity leave for 12 months, it's actually put a hell of a lot of pressure on the first purchase, hasn't it? It's basically said to us that, well, we really needed quite a lot of your money. I mean, that was almost, over a third of the money that we had in terms of our cash flows anyway. So by her and them deciding that first property is in jeopardy. So what we now need to do is look at, okay, what are the ways in which we can make that property work well for you? So that $350,000 purchase might need to be at 6%. Now that's achievable, 350,000 earning late fives, early sixes. It's difficult in the Victorian market and the Melbourne market, but who says we have to buy here? We should be scouring the country to find those opportunities, and that's what we do for our clients, and you should be doing the same, because if you know what you need to achieve, and you can see there that yes, we still are going negative, but we've just cut through, now it's super tight. Now, would I be advising clients to actually adopt that? No. But what Amanda might choose to do is she might actually say, you know what, I'm going to go on maternity leave for 6 months and do rough return to work for 3 days a week or something until the child's a little bit older. So these are all the real-time things, and this is life. We're helping people make the best decisions with their money. So this is real. This is what we do each day when we sit in front of clients. Now, let's assume we're able to grab that second property in 2017. Let's now go back and have a look at what that's done to our overall wealth creation position. Okay, so again, we've sacrificed our retiring debt concept. We've got a nest egg of now 3.2 million, and we've generated income of $130,000 a year passive. And the story's getting nicer the longer that they live. That's 2 investment properties. But yes, they've got a longer time frame, don't they? So it's easy when you start young. If I had my time over again, I wish I had versus I'm glad I did. These are all the conversations that, people are having. And, that's no different than a personal journey that most of our guys have gone on. We're fortunate that we're passionate about what we do, and we started our investment portfolio in our 20s. So that just gives you an idea. Now, remember I said how important asset selection is? So let's just assume that that's at 7%. All of those numbers are at 7. And just for illustration purposes, why don't we just up the ante? What is it that we actually got educated and we understood what the importance of selecting a great asset is? Just how much value will that give to our overall circumstance? So let's say we got 8.5% instead of 7% growth. Now, the Valuer General has reported since 1974 that the median house price in Melbourne has grown at around 8.3%. That's the median. So some suburbs we know have grown at around 11% compounding, some pushing almost 12%. Others, disastrous, 5% or lower. So the question is, what does that do to our overall wealth creation? Let's do both of them. Yep. So not only did we get a great yield area, but we also picked a great spot. We picked a quality investment grade asset, and Kate's been out there and she's got it. Bryce has been out there and they've found it and they've negotiated well, and bang, we've got it. What does that do? 1.5%. And I've got no power left in my red. So here we go. $178,000 difference. A wealth difference of 3.2 million to 4.4 million in present value terms through good asset selection. So, you know, when people pay a professional fee, if they're going to deliver those type of longer term wealth creation outcomes, then we're going to be in a better position, aren't we? I mean, is that value? Would you be happy if someone's delivering those type of wealth outcomes for you? You should be. Or if you put the hard work into you creating that for yourself and understanding what drives value and picking the right asset and getting an outperform result. I mean, some of the analysis that we're doing in our business right now is not clearance rate by suburb, it's clearance rate by property style, by bedroom. Now, if we know that 3-bedroom houses in North Fitzroy have a clearance rate right now of 78%, does that tell us that there's a hell of a lot of demand for 3-bedroom houses in North Fitzroy? And does that mean that if we can get our clients in on that game or something just nearby, we talk about, you know, the wave rider, is that going to help our client get a better outcome? If we know that 1-bedroom apartments in St Kilda are tanking and they're clearing at 48%, now I'm not saying they are, so please don't take that as advice. St Kilda is a very good area, but they're the types of things that you don't have time for, and you probably don't have access to that data. You know, that's why we have someone in our business working on this information full time. Because if clients are paying us, they expect results. Now, Bryce also mentioned earlier about that accountability partner and just having just a plan. I mean, the greater probability of you putting something on paper is heightening the potential outcome that you're going to get. So I encourage you all to think about how much income you need in retirement. It's the first thing you need to do. Once you understand that, then you can start looking at your journey. And if you want to come in and have a conversation around that journey, it's complimentary, that first conversation. But all we're going to show you is where you're heading.